Good morning, everyone. Looking at the exponential growth of AI in the past 2 decades, it has become an integral part of the modern economic industry. However, AI focuses on patterns and trends, while financial markets have a bad reputation of breaking them. With the structured growth that AI has shown us in the past, with mix of volatile nature that financial markets bring to the table, it is interesting to see how financial companies are adopting AI, primarily to bring in the factor of stability. My name is Shrey Raval. I am principal investigator at Durham College. I welcome you to the first panel discussion of the Enable AI Summit 2022. My guests are Dr. Jonathan Rodgers, joining us from Bahamas, and one of my research colleagues, Saba Siddiqi. And today, our discussion will focus on the roles where artificially intelligent systems are playing for predicting the movements of the financial markets. I'm going to ask each one of them to introduce themselves and tell us a little something about themselves on what they do, who they are, and a good amount of their background. We'll start first with the Dr. Rogers. Please take it away.
Good morning, everybody. As Shrey said, my name is Dr. John Rodgers. I'm an ophthalmologist by profession, and I live and work in the Bahamas. I was trained in England, and I did my ophthalmology residency and fellowship programs at the University of Toronto. I've practiced in the Bahamas here since 1984. But I have another life, and I've always had an interest in economics, in finance and education. And to that extent, I was the chairman of the board of the University of the Bahamas until October of last year. And I've written several books on the economy of the Bahamas, and also written several papers and numerous presentations on the monetary system in the Bahamas, especially as it pertains to exchange controls. But I also have an interest in finance, in particular, how the monetary system works and how it affects finance and economics. And 3 years ago, I had the pleasure and honor of hooking up with Professor Ali from Durham College. And we have been working on 3 projects over that period of time. The first is that we have developed a new digital currency that is basically inflation proof. It's really going to be the world's first smart currency. Secondly, we've developed a community payment platform that will be introduced in 2023 in a certain district in Ontario, which will enhance the economic activity in the area for residents, local government, and also for businesses. And more recently, we've developed an AI program that will allow us to predict with a fair degree of accuracy what's going to be happening in financial markets and the economy in the future. Now, you may ask yourself the question, what's an ophthalmologist doing getting involved in finance and economics? And the answer is quite simple. In medicine, we have to learn how the body works, what can go wrong, and how to fix it. And this applies to any system. So I applied this methodology to economics and finance, and it has served me well over the years because the economy and finance both are systems, and if you understand how they really work, then you can understand what can go wrong, and therefore how to fix what has gone wrong or remedy it. So that's a little bit of background on myself. Thank you.
That's a good explanation that you gave, Doctor, especially connecting the dots with human anatomy and the financial markets. Good one. Saba, please.
Thank you, Shrey. Thank you. Hello, everyone. I am Saba Siddiqi. I am electrical and computer engineer by profession and currently working as a research lead at AI Hub Durham College. Just to give a bit of overview of what I do and what AI Hub Durham College does is we work with different businesses at different levels. It could be a business that has just started, and it could be a business that have been there for a while. So for example, a business that has just started, we help them build their data sets, help them understand what they can possibly do by leveraging AI and all the possible solutions they can adopt. Now, another thing, we also get a lot of businesses that have been in market for a while. They know what they want to do with what they have, and we help them build solutions. We have worked with various businesses to build them APIs, softwares. It could be web applications, mobile applications, AI based, and then visual dashboards. So we have been working with these companies. And the best part about this job is each day you get a project that is different. All the companies we are working with, there are different sectors. You get to work with maybe a doctor, someone who is in real estate, someone who is educating, and all these different people, all these different companies. You are solving a new problem every time, and it's a new challenge every time, which keeps it exciting. Not only we are giving back to community by helping these businesses, making a difference. Another thing that makes this job very important to me is we are helping students as well. As a part of these projects, students get to know these companies better, how the project management structure works, what skills they need to learn when they go out in the market. A lot of our students, they have worked with these companies and they have been hired as well. So they are getting trained, and that is something I love about it. And so if you are a student who is looking to get into AI, I would like to know what skills you would like, you should polish to get into market, feel free to connect. And also if you're a business and looking for ways to leverage AI or have any questions regarding AI, feel free to connect as well. Thanks.
Thank you, Saba. It was a very well explained thing. Dr. Rogers, likewise, once again. So, going to the main topic of our discussion, that is the role of AI under the financial domain. Now, we have learned over the years that how financial markets have played around the whole world. It has operated the world and it has brought out the modern industrial revolution, which we already face right now. Now, let me go and skip 200 years of discussion right away and go to doctor and ask him right now that, doctor, if you can please explain us a little bit about why you were interested in applying AI to the financial models. I totally understand the fact that how expert the level of expertise which you have amongst the financial domain right now, and looking at this sector where the AI is developing, it would be interesting to know if you can please.
Sorry, I didn't know. Where's the money? Sorry about that.
Sorry about that. The reason why I'm so interested in this is because, as I think we've all realized and noticed over the years, financial analysts and economists have an appalling record when it comes to predicting and forecasting what's going to happen in the economy and what's going to happen in financial markets. For example, in 2007, Ben Bernanke, Princeton-trained economist, head of the Federal Reserve, said that he didn't think that the subprime problem would spread and become systemic. And in 2008, of course, it did. It became a worldwide global problem, and it was a financial crisis and an economic crisis. Now, we are guided as households and businesses and also governments by the forecasts and predictions of economists and financial analysts. And when they get it wrong, we certainly suffer, as we have all done since 2008. Of course, there's nothing that happens to the economists because Bernanke, Princeton-trained economist, an expert in the 1929 recession, still earns $250,000 for 40-minute presentations around the world. But we, the globe, in terms of the economy and finance, has suffered. I believe that there are a couple of primary reasons why their forecasting is so bad. And the first is that they have a lack of understanding of the impact of the monetary system on the global economy and on financial markets. And two, they look at the economy and financial system as a simple system, when in fact is an example of a complex system. So we look at the impact of the monetary system in terms of how economists look at it or don't look at it. One of the commonest or most well-known equations in economics is the GDP equation, which is GDP equals consumption plus investment plus government spending plus net exports. Now, all of these variables depend on the money supply at the point in time, the expansion or contraction of money supply and credit, and the flow of money through the financial markets and the economy. But there's no variable that speaks to the monetary system in that equation. If we look at the financial side of it, one of the best known theories in finance is the efficient market hypothesis, which basically says that everybody knows all of the information pertaining to a particular stock, and they act on that information, and they either buy the stock or sell it, depending on what the information is. And that determines the price of the stock. But the fact of the matter is, it's quite different from that. Yes, when quarterly earnings come out, people may look and see if the earnings of the company weren't as they expected them to be, then they might sell the stock. If they were better, they may buy it. But that only applies to an individual stock. When you see dramatic short-term changes in the market, it's usually due to a lack of collateral in the global monetary system. And that is what causes these big changes in the markets as a whole. When you see longer-term trends in the stock markets, it's because of the money supply, the increase in credit. So when you have an expansion of the money supply, expansion of credit, you get a path that occurs is something like this. The money goes into financial markets, first of all, into fixed income, equities, then it goes into venture capital, private equity, Bitcoin, and other more risky assets. And then it goes into the general economy. When it goes to the general economy, you get some inflation and you get economic growth. And then the reverse happens. When the markets, and I'll come to the markets in a second, see that there's more risk in the system because, for example, the markets are frothy in housing or in the stock market, or the economy is over bubbling, so to speak, they become more risk adverse. They create less money, less creation of money, less supply of money, less liquidity, and you go back the other way, contraction of the economy, decreased GDP, and a decrease in financial assets in the financial markets. So there's an ebb and flow. Now, these financial markets or the entities that make up this, the financial markets that create the money supply, that create the contraction, expansion of money, is not the central bank that most people think in each country. Is actually a conglomerate or network of a large number of global banks, pension funds, hedge funds, insurance companies, sovereign wealth funds, the reserve assets of central banks, all working together to create this money and this increase in the money supply. And risk on, they cut back, risk off, they increase the supply, and the money flows through the system. Now, with regard to systems, the economists and financial analysts make predictions based on probability analytics, based on the normal distribution curve, that dome-shaped curve that we all learn about in school. But the problem is that only works for a simple system. For example, the height of men in Ontario might vary between 5'7" and 5'10". It doesn't work for, and there's a 97% chance, going one standard deviation out, that 97% of men in Ontario will be in that height distribution. But it doesn't work for complicated systems. So finance and economics is an example of a complicated system. Now, if you actually plot out the economic and financial events, you'll see that they actually follow a power curve. And a power curve is like a normal distribution curve, except it has two great differences. The dome is narrower, and the right-hand tail of the curve extends outwards. It never hits the horizontal axis, which means that bad things happen with a greater frequency than the normal distribution curve would predict, and there's no end to the number of bad things. So let me give you an analogy. Let's say the snow is piling up on the mountaintop, and then it keeps on getting bigger and bigger, and of course, there's always the threat of an avalanche. But you don't know when that avalanche is coming. However, one small flake of snow may fall on the top of the avalanche of the snow pile, and the avalanche occurs, and all hell breaks loose. So was it the snowflake, or was it the fault lines in the snow pile that caused the avalanche? Well, of course, it's the fault lines. So if you can recognize these fault lines, then you know that when the avalanche occurs, what's going to happen, and you can deal with that, or you can blow it up before it actually happens and preempt it happening. So how do we extrapolate that to what I'm talking about with finance and the markets? Well, we've discovered that there are certain fault lines in the economy and markets that we can see and identify that will pertain to what's going to happen in the markets. In other words, the fault line will tell you, or the marker will tell you whether there's going to be expansion of credit or credit is going to contract. So if you know if it's going to expand, you know the path it's going to take through finance and through the economy. It's going to contract, it's the other way around. So if we can identify a marker or a fault line, then we can predict exactly when these things will happen, because as the money flows through the economy and or through the financial system of the economy, it flows with a specific pattern. Now, we've been able to identify 8 of these markers or fault lines, but the one we've chosen to start with in our model is the exchange rate or the value of the US dollar as it pertains to other currencies. Now, just bear with me for a second, because it gets a little bit tricky. In this global monetary system, when it contracts down, there's usually a shortage of US dollars. So the supply shortens given the demand. And when that happens, the US dollar goes up or appreciates against other currencies. So that's the marker that we are using. We can predict now with amazing accuracy the value of the US dollar versus the yen, the yuan, the pound, gold, and the euro with great accuracy, up to 4 to 6 weeks forward. So if, say, for example, we're predicting that in 6 weeks' time, the US dollar will be appreciating, we know that means more liquidity, more expansion of credit and money supply, and vice versa. So this is important. And we're going to, next year or so, add in the other 7 or 8 markers that we've identified to make this model even more accurate. Now, why is this important? It's important because people want to know what's going to happen in the economy, recession or boom, what's going to happen in financial markets, and when it's going to happen, when a stock's going to go up, bonds going to go up, when's private equity going to expand. It's also important for all persons who deal in trading of financial derivatives or currencies. And by the way, these markets are far greater, trillions of dollars every day, than the stock market or even the bond market. And also, it's very important for anybody who has borrowed monies in US dollars, emerging markets, countries, private entities. If you've borrowed in dollars and the dollar appreciates, you got a problem, because the value of your principal goes up and your debt servicing becomes more onerous. And especially if you're having to refinance at any point in time. And remember, there's about $300 trillion globally every 5 years of debt that has to be refinanced. That's roughly 60 trillion every year. Now, if you come around to financing when there's a contraction in the creation of credit money supply, you got a problem. So this is why this type of modeling is very important, because it will enable economists and financial analysts to better predict what's happening in the markets and in the economy. And because we're guided by these individuals, we'll all be better off as households, businesses, and governments.
Excellent explanation, Doctor. It was very well understood where you explained the 8 parameters or the 8 indicators which you guys have discovered. Now, based upon this discovery, once we are able to automate that into AI, of course, I see your interest on why applying to AI to financial models is going to be helpful and extremely going to be helpful. So now over here, let's talk about a little bit and go into the technology end, where we are picking up the models to predict it. Now, models, if I want to say or give a little bit of explanation, are the main basic boilerplates which explain us that how the AI is going to be implemented. Regardless of being any model, any types, let me go to the AI expert over here and ask her, Saba, so this question is directed towards you. What are the challenges with picking the right models to use for financial analysis? Looking at such volatility, I believe it's going to be a very difficult job for you. So if you can please put some light on it.
Sure. Thank you, Shrey. So Dr. Rodgers here have explained it pretty well. I'll just add a bit to it, more of it from a technical side. So when we say financial analysis, AI can help us to solve a lot of different problems, right? It could be the classification problems where we are looking for fraud, risk, and then it could be the prediction problems where we are forecasting, like the things we just discussed. One issue that we have, one major issue that we see here is the anomalies, seasonalities in the data set. Because of the crisis, global affairs, all these pandemics, wars, we see an effect in the data. Sometimes it's predictable, sometimes it's not. That's where it gets tricky to predict something. Now, a lot of different companies have been working on it, but we are not quite there yet. As in, if we talk about the models that are readily available for normal people to use, right? One of such example is FB profit model. They are currently taken into consideration the holidays, but that's not enough. Like we have seen the past few years with pandemic and everything, and we see how the graph is going down. And it was really hard to predict at the very beginning of it, right? But I have the opportunity to work with Dr. Rodgers and his team, and I'm really grateful that they are working on this solution that's gonna help in long term, right? The way he mentioned that they're using the contraction and expansion of money to make predictions and how they are adding different markers to it. I see we have a future there. They have already worked on a solution and working on it. And we need more solutions in this particular problem because we are seeing predictions, but we are nowhere near accuracy for the publicly available models that we have.
Understood. So again, it was another conversation where the technology standpoint drops in and says that, okay, I'm going to provide you computing power. I'm going to provide you the mathematical equations, but not sure if it's going to be right prediction or not. So again, it's a contention over here. Over here, more so towards when we were discussing this, then I saw one of the very interesting question coming in from a person named Siddharth. So I think, Dr. Rodgers, this question is directed towards you, that can we predict, looking at the expertise of the economical standpoint which you brought in, can we predict or stop getting to the situations which Sri Lanka just is in right now? I mean, the indicators which you just suggested, like it provides you a barrier, it provides you threshold values and certain stuff like that. So do you believe that are we able to, or are we at a point where we can get to these equations or the solutions and utilize them for such predictions?
Well, just to go over what Saba said, we went back 20 years and we looked at the impact of every single significant financial and economic event on the value of the different currencies, the pound, the renminbi, the yuan, the dollar, and gold. And the reason why we actually did that was because our digital currency consists of those different currencies plus gold. And it was my hypothesis that because it's a smart currency, it would always hold its value. And in fact, that's exactly what happened. Every time there was an event, the traditional fiat currencies went down or stayed flat in value. Gold went up slightly, but our currency, which is called dinero, actually went up like that. When you have a crisis, no matter what it is, the bottom line is, what impact is that going to have on the monetary system and the economy? So let's look at, for example, let's say Russia. What's happening there right now? Okay. Not too much in terms of the monetary system per se, because they found a way around the monetary system. Yes, there were sanctions, SWIFT, and all SWIFT is a messaging system. So all the Russians have to do is actually use the telephone, a mobile phone, instead of using SWIFT. They don't have access now to dollars like they had before. But is that so? No, it's not so, because they're still making $1 billion a day in income from the currencies or the oil that they're selling. And the oil that they're not selling to Western Europe, they're selling through the Chinese in other parts of the world. Now, I made a reference to collateral and risk in the previous section. So you say to yourself, okay, are the markets now concerned by the amount of risk in the system? Well, not really, because the markets really haven't tanked that much because of Russia, because it hasn't stopped the flow of money into the markets. The reason why the markets have been going down is because if you actually look at the yield curve at the US Treasury yield curve and also the Eurodollar yield curve, when the right-hand end tends to go down or become inverted or flattens out, it means that the markets don't see a very good future for the economy. And so what people do is they see there's more risk. So what do they do? Because the stock markets are very high, housing is very high, that's frothiness, that's risk. So what they do is they become more risk adverse. What do you do when you become more risk adverse? You sell your risky things and you buy things that are perceived to be the least risky. So what they do is they buy treasury bills and bonds, the most pristine of collateral, and also the thing that has the least risk attached to it. So when you buy those bonds, the price goes up, but the yield comes down. And that's why the yield curve comes down at the far end. And that is going to be another one of the markers that we're going to be using in the future in our model. So the answer to the question is, when these events occur, you see changes in the value of the currencies, as we talked about before, and whether the markets become more risk adverse or less risk adverse is determined by how much they see that event as being a threat to the monetary system And that's manifested in the flow of money and the creation of money from the system from that point on. Now, if we go back to 2008, what happened then, the flake of snow then was the subprime problem. And you see what happens is in these markets, these money markets, people use what they call repo transactions. So what they do is Bank A will lend money to a hedge fund overnight, say $100 million, and that hedge fund has to post up collateral in order to secure that loan. And the collateral may be treasury bills or bonds, mortgage-backed securities, sovereign debt, corporate debt, whatever. So they take a haircut. That is, they have to post up more collateral money-wise than the money they're borrowing. So if in the event they don't pay the money back, the lender can cash out on that collateral and be saved. So during that period of time in 2007, 2008, a lot of the collateral used in these markets was actually mortgage-backed securities. So when their value went down, investors and the banks had to reprice that collateral. And that caused a total breakdown in the entire monetary system, because sometimes those forms of collateral are rehypothecated up to 32 times. That is the same collateral maybe used by 32 different institutions in these deals. So what happened was, that was the snowflake. And the avalanche was the banking system globally froze. And if the banking system freezes, the economy collapses because people have to have access to credit. There's no credit, no economy. So that's how the system works.
Right. So, Doctor, I actually have one quick follow-up question onto this. And Saba, I'll get back to, I do have one of the most interesting question based on a similar conversation. So, Doctor, this one is again for you, where I have seen this factor, like when you brought in the example of 2008 subprime mortgages, that the major impact which happened was in communities and people. It was on a very granular level that this impact happened. Can you comment, like with a point or two, that how such predictive modelings can help mainly the communities and the people?
Yeah, sure. So as I just said before, one of the problems of economic data is the availability and the format in which it is in. Most people are not only financially literate, but economically illiterate as well. So our job, in part, is to educate people so that they can understand what is going on and understand the data in a very easy format. So they can see that the markets are going to be tanking in next 6 months. The economy is going to be going into recession. So for example, today interest rates for mortgages are around 5%, and the economy is ticking along at about 0.5%. Okay? Now, when I say 0.5%, some of you say, well, no, the Bank of Canada says it's 4.5%. That's just in relation to the month before, not in relation to the economy back in 2018, 2019. Okay? So the economy is at 0.5% real growth, and interest rates is 5%. Now, perhaps I want to buy a house. But if I know or learn from our models that in 6 months' time, interest rates may be 2%, and the economy may be growing at a greater rate, then I'm going to hold off before I buy that house. Correct? So that's how it can be helpful to individuals. And by the way, the higher interest rates are, the more likely you are to get a loan from the bank, because the bank can then make more money. Okay? Because another fallacy in the whole system is we've been fooled by the Bank of Canada, by the Federal Reserve, into thinking that quantitative easing, which is buying the Federal Reserve or the Bank of Canada, buying bonds from the banks and putting money in the banks, that the banks will then lend that money out to the rest of the economy. But that's all smoke and mirrors, because the money that the banks put into, the central bank puts into the banks, is what's called reserve money. It's not real money. That's not lent out to the economy. it's still up to the banks to determine whether they lend the monies out, right? And they'll lend the monies out if they think the economy is going well enough so that your business will be able to make enough money to pay back the loan. And if they can make a profit because the interest rates are high enough for them to make that profit. Okay? Another example would be if you want to start a business and the economy is not going so well right now, and you can look at our predictive model and say, okay, 6 months to a year, it'll probably be better. Well, maybe you'll hold off and start the business at a later date. Another thing that we're doing, and as I say, this is going to be done in one of the districts nearby to where you are right now in 2023, is we've developed a new digital payment platform, and that will be able to track every single transaction in that community 24/7. So let's look at this thing. Let's say this economy is like a balloon, and the digits in that balloon represent money. And the digits moving around represent the velocity of money or transactions taking place between individuals. Now, if you take that balloon and you narrow it down into a tube, and then you look at the flow rate of the money through the tube over a period of time, that's a real live 24/7 indication of economic activity in that region. And you'll be able to segment it. So different parts of the community may be more economically active. Different times of the day, the economy is more active. And the district authorities will be able to look at all of this and better project in terms of their budgets. Individual businesses will look and see where the downtimes are. That's when they have their specials, for example. So we just need to make economic data and financial data more readily available. And I would actually predict that with the world moving towards digital currency and getting away from paper money, that GDP in the future will not be reported as it is now, which is every quarter, but is retroactive to the quarter before, okay? And often there are revisions made to it. What you'll see at the end of every day is, for example, the Dow Jones was this, S&P was this, the NASDAQ was this, and the economic activity in, say, Durham was $20 million from 9 a.m. in the morning to 5 p.m. in the evening. And that's real-time economic data that's available, and you can see right off the bat where you are.
Amazing explanation, doctor. Amazing. Simply. Now, I'm going to actually pick one single point which you brought up over here in between the whole conversation, which was you need to recognize that, okay, if interest rates are lower, the banks are pretty much, what do we say, difficult to get loans out of them. But 6 months down the road, you need to recognize that, okay, the interest rates will be 2%. Now, how do we recognize that? We need to realize the accuracy of any AI model or the predictive modeling should be very high. And we have seen this, and all the people who are working as a data scientist or the AI engineers, they recognize this fact that determination of an accuracy is extremely difficult. Now, I'm going to turn it over to Saba and ask her, Saba, in your experience with the models that you have built, with the expertise which you have gained through the whole AI domain, how do you determine the accuracy of any model and how do you improve it in any sense?
Sure. Thank you, Shrey. So I'll start from a high level and then we can break down. Just to understand how accuracy works for the model, the basic accuracy, that is the classification accuracy, we can understand. So let's say we have 100 samples and we calculate accuracy based on total number of correct predictions that we got. So that's the basic way of doing it. But the problem with that is, let's say we have 100 samples, but we have 98 positives and 2 negatives. Then what happens? Then let's say that final result we get is 100% positives. to be honest, 98% are already positive. That means we have got 98% accuracy, but that's not the case, right? Because we haven't got those two negatives. So it basically depends how your data is. In this particular case, your data is imbalanced. So there are various ways to implement it. One could be, let's say you want to penalize the false classifications. That's where you put logarithmic loss. So that's another solution. There are various ways to study the matrix for your accuracy. You can create confusion matrices and then see how it works. It gives you a total count of true positive negatives, false positive negatives. And then from there, you can drive various parameters. Let's say precision of your model is important to you, then you want to go for F1 score. But at the same time, these are some examples of the classification models. And in matrices we use to find accuracy. And then if you're going for, let's say, forecasting problems and then predictions, you might want to go for mean absolute errors and deviations and things related to that. But even with those matrices, you do get some issues regarding, you don't get to know whether your model is under predicting or over predicting, right? So that's something you want to look at. In a nutshell, whatever method you're using to determine your accuracy, you need to understand what's important to you in your model and how your data set looks like. Like I mentioned, whether it's imbalanced, then you want to go for a specific one. If you're looking for precision, and then you want to go for a specific one. In addition to that, most of the models we deal with in financial sector, like Dr. Rodgers already mentioned, they are not linear, they are complex. That's where the external factors come in. That's the things we call markers here, right? So we want to make sure we determine that what are those markers, what are those external factors that are making a difference, that making an impact on the accuracy of the system. And we plug those in the model and see what's their effect to calculate the accuracy as well.
I believe that's a very smart way to do that. I mean, when we have certain indicators which are manual to see that, we can see that, okay, interest rates are falling or something is going up, and we can recognize that, okay, what if we automate these procedures? And again, Saba, excellent explanation on how do we automate these procedures and combine them with the whole AI integration piece along with the financial domain. Now, over here, I see one specific gap which needs to be bridged, which is when we see the trends in the industry, in the financial industry especially, that there is high level of volatilities, we can assume that, okay, tomorrow this is going to happen. Model is going to say that tomorrow this is exactly what's going to happen. But we see the other way around. So, doctor, this question is directed towards you, that can you speak something about the certain trends which you are seeing in the industry related towards the financial modeling?
Well, if you leave it up to economists, there aren't going to be very many trends at all, because most economic theory is over 200 years old, and economists seem to be reluctant to come out of the box and embrace the new knowledge-based technologies which are available, which can really help them a great deal. So I was thinking about this, and there's several areas really. Let's look at sentiment analysis. Economists use consumer confidence indices. They use purchasing manager indices. That is, they call up and do surveys, different companies, industries, and ask them what they think is going to happen in the future of the economy. And if it's above 50%, say positive, then it's positive. Below 50%, it's negative. Okay. But how well do these things really correlate to what actually happens? And the reason why sometimes they don't always correlate is because, often people don't say what they think, or they do what they think, or they do what they say. So it's very difficult to know when somebody says yay or nay on a survey, well, not that's exactly what they're thinking and what they're going to do. So we can use, I think, AI to just look at this correlation between sentiment and what actually happens in the economy down the road. And I think this is why the famous economist Keynes once said, I just quoted to you, he said, markets can remain irrational longer than you can remain solvent. And this is what he was really speaking to, because in those days, they didn't really have the capacity to use the methodologies that we have now to see these different correlations. Okay, the second area is that we can use AI to look at the relationship between what I call quantitative parameters, as opposed to look at the relationship between GDP and qualitative parameters as opposed to quantitative parameters. Now, what do I mean by that? Most economists will say, well, GDP is related to land, labor, and capital, and the effect of technology on those parameters. However, I look at things slightly differently, and I think that there are more qualitative factors involved. For example, education, healthcare, infrastructure, national security, rule of law, diversity, ethnicity, and inclusiveness in the corporate sector. So what I mean by that is, if you have well-educated people who are healthy, working in a safe environment with good infrastructure and as good rule of law, then they will thrive. They will produce. Government will make money from taxes, and the economy will grow. But if you look at the US, for example, it has everything except perhaps national security. Its diversity, ethnicity, and inclusivity is not that great. And we know that those are very important, because those companies who adopt that methodology are more profitable, can solve problems better, and their workers are happier. Look at China. Well, rule of law is not that great. Infrastructure is what they're really focused on. National security is pretty severe. Healthcare is getting better. And education is where they're really excelling. So we can use AI to determine which or all of those things are the most important in economic growth. With regard to education, the OECD countries have an exam that all of their 14 or 15-year-olds take every year. And then they're graded according to country. And Finland and Hong Kong always come out on the top, okay? And there was a Chinese economist who looked at this, and she correlated these standings in the PISA with GDP per capita. And guess what? It came out exactly correlated. Those at the top had the greatest GDPs per capita. So that's another area. And then the final thing that I was thinking about was two final things, is that we know in economics that the workforce times productivity equals GDP. So population or workforce times productivity is GDP. So if your workforce increases or you become more productive, your GDP grows, and vice versa. Now with technology, say for example, robotics and even AI, that's going to put a lot of people out of work. But it also is going to make us more productive. So you may end up in a situation where you get fewer people working, and therefore they have no income, and they can't afford to buy the things which are cheaper. The technology is made cheaper. And as things become cheaper, what's going to happen to companies who are making these things that we're buying from them? Their margins are going to go down. And the first thing they do when the margin goes down is they fire workers. So there'll be less people working. So we need to use AI in a real serious fashion to determine what's going to happen with the population workforce, with productivity, and the impact it's going to have on all of us. Because by 2030 or 30%, 30% of all the jobs that, especially in the service-based industry, are going to disappear. And that has implications for emerging markets too, because in Africa, for example, fastest growing GDP in the world, fastest growing middle class in the world. But they're not going to be able to benefit from that workforce like China did and Vietnam and Cambodia are doing, because there may not be any jobs for those individuals because they'll be replaced by robots. And then something even more futuristic is looking at individual productivity in young kids and trying to project how productive they'll be in later life. So I'm now looking at some of these features or characteristics of young children, age 5, for example, creativity, persistence, intelligence, and the other things that bring it to mix are auditory processing and visual processing, to see how those things rate them on those different areas, and see how that is going to impact how productive they are in later life. So we'll be able to project future GDP based on the productivity of individuals at a young age. So those are some of the things that I think need to be looked at.
Absolutely, doctor. So those three factors which you just mentioned, all about execution, all about action, and it is one of the most controversial thing, not controversial, but one of the most important thing to realize is it's always better to act upon rather than just to talk about it. So let's go into that discussion where I want to ask Saba this thing, where how can companies actually get started with using such AI forecasting models? Because at the end of the day, we can talk about it all day. We can talk about AI can do this, AI can do that. It will be improving financial market by this much level, etc. But what's important is the action of it. So Saba, if you can talk a little bit about how AI models can be adopted by the financial industry to better understand these trends.
Sure, sure. Before we dive into how AI models can be adopted, one important thing and that I tell my clients and students too is to focus on the data first. As long as we have the proper data, we know what we are dealing with, the next steps are easier. So let's say if you are working with forecasting problems and you want some data that you already do not have, for just let's say stocks, currency, there are various APIs that offer that. Depending on the cost of them, you can get better and complete data as well. You can use that to get started. On the other hand, if you are performing any financial analysis within your company and you do not need external data, then you want to make sure that you have enough data to work with, or even if you have data, you want to make sure it's clean and it's in a usable format. I have worked with a lot of companies who have everything they need, but it's not in a proper format. They do not have centralized databases that you can use. So that's the first step. Once you are there, you need to understand what you are looking for, right? What is your final goal that you're working on? Once that final goal is set, you can then start working on your models. But before we had there, another important thing is not all the stakeholders understand how SQL or databases or these models. We need to make sure we have some visualization dashboards as well. That's another thing that's important within the organization. How are you visualizing your data so that the team members in your team can see the analysis you have done and how this is going to be used? Let's say even if you're using models and predicting something, you just cannot show them the scripts and see this is what I have done to make them understand better. You need to find a way to display it. It could be charts, plots. A lot of applications are there to show these results. So this is something we wanted to implement these solutions.
Absolutely. I mean, in a way, the AI solutions are not just a bunch of numbers. They are also something which are being conveyed to the audiences as well at the end of the day. So, Sabah, I just have one quick follow-up question on that last sentence which you just provided, like the data, charts, and plots. Now, how important is the storytelling or the visualization part of any AI Since finance is all about numbers, we can see the graphs and charts and we can see it all day because that at the end it will be just lines and dots. But how to understand them, how to convey the message to your audiences? Can you talk to me a little bit about that messages?
Sure, sure. So an important factor of working with all these data sets and models is making sure you are able to um, share what you're doing with the audience, right? When you mention storytelling and all these databases, there are various applications available in the market that you can readily use. But there is a reason we have data analytics as a field now. And we have people working on basically researching how should you be displaying data so that all the stakeholders are able to understand it. Because at the end of the day, what happens, a company is coming to you to get a solution, right? They are with you here because they cannot work on that data or that solution themselves. Now it's your job to make sure they are able to understand what you do. So you just don't need to be just technical, but you need to make sure you're able to share whatever information you have with all the stakeholders at all levels.
Absolutely. And I mean, as I said, at the end of the day, it is more about action, and action can only be taken once you know what to act upon. And without that, you just simply cannot do. So I believe that would be the end of my questions. If there are any questions in the comment section, please throw them away. We have a couple of minutes to go. I'll just quickly summarize what we discussed right now. So we started with the whole interest in applying AI, as simple as that. And that conversation went to how to convey to your stakeholders, convey to your storytellers in every single fashion, from determining the trends in the industry, the financial markets, towards determining accuracy of it, looking at the matrices, what not to do, what to do at certain times. And from the domain expertise of Dr. Rogers, we got a huge economic perspective, I believe, on recognizing that how financial markets play on a global scale. We also saw that how they work in a community level, where simple as small little thing as a simple subprime mortgage loan, which is like a small interest rate on a single loan which the bank provides, that impacts and how that impacts the global scale of it. So again, I believe it was a very good conversation between all of us. I would like to thank Durham College for providing this opportunity to have this discussion, showcase all the skill sets which we have, the domain expertise which we share right now, and the love of AI, including finance, which we share all together. Thank you all for joining. Hope you had a fun time and learned something new at the same time. Thank you.
Thank you.
Thanks.